As I said, there will be pundits who will see the news as bullish and others As I said, there will be pundits who will see the news as bullish and others who will see it as bearish. And the reporter gets to pick one of her report. Are you going to let a reporter make trading decision for you? That's insane. If that reporter could trade, she would be a trader and make hundreds of times more money than she is making as a reporter. Why would you ever allow her to influence your decision making? You might do so only out of a lack of confidence in your ability, or perhaps you are searching for a father figure who will love and protect you. If you are prone to be influenced by a reporter's decision, you should not take the trade. The pundit chooses is not your father, and he will not protect you or your money. Even if the reporter picks a pundit who is correct on the direction, that pundit will not stay with you to manage your trade, and you will likely to stop out with a loss on a pullback. Financial news stations do not exist to provide public service. They are in business to make money, and that means they need as large an audience as possible to maximize their advertising income. Yes, they want to be accurate in their reporting, but their primary objective is to make money. They are fully aware that they can maximize their audience size only if they are pleasing to watch. That means that they have to have interesting guests, including some who will make out outrageous pre-predictions, others who are professionals and reassuring, and some who are just physically attractive. Most of them have to have some entertainment value. Although some guests are great readers, they can not help you. For example, if they interview one of the world's most successful bond traders, he will usually only speak in general terms about the trend over the next several months, and he will do so only weeks after he has already placed his trades. If you are a day trader, this does not help you because every bull or bear market on the monthly chart has just about as many up moves on the intraday chart as down moves, and there will be long and short trades every day. His time frame is very different from yours, and his trading has nothing to do with what you are doing. They will also often interview a chartist from a major Wall Street firm who will his credentials are good, will be basing his opinion on a weekly chart, but the viewers are looking to take profit within a few days. To the chartist, that bull trend that he is recommending buying will still be intact. Even if the market falls 10% over the next couple of months, the viewers, however, will make their losses long before that and will never benefit from the new high that comes 3 months later, unless the chartist is addressing your specific goals and time frame. Whatever he says is useless. When television interviews a day trader, instead he will talk about the trades that he already took, and the information is too late to help you make money. By the time he is on television, the market might already be going in the opposite direction. If he is talking while still in his day trade, he will continue to manage his trade long after his 2 minute interview is over, and he will not manage it while on the air. Even if you enter the trade that he is in, he will not be there when you are. Invariably will have to make an important decision about getting out as the market turns against you, or as the market goes in your direction and you are thinking about taking profit. Watching television for trading advice under my circumstances or any circumstances, even after a very important report, is a sure way to lose money and you should never do it. Only look at the chart and it will tell you what you need to know. The chart is what you will give you money or take your money from you. So it is the only thing that you should ever consider when trading. If you are on the floor, you can't even trust what your best friend is doing. He might be offering a lot of orange juice calls, but secretly having a broker looking to buy 10 times as many below the market. Your friend is just trying to create a panic to drive the market down so he can load up through a surrogate at a much better price. Friends and colleagues freely offer opinions for you to ignore. Occasionally, traders will tell me that they have a great setup and want to discuss it with me. I invariably get them angry with me when I tell them that I am not interested. They immediately perceive me as selfish, stubborn, and close minded, and when it comes to trading, I am all of that and probably much more. The skills that make you money are generally seen as flaws to the layperson. Why do I no longer read books or articles about trading or talk to other traders about their ideas? As I said, the chart tells me all that I need to know, and any other information is a distraction. Several people have been offended by my attitude, but I think in part it comes from me turning down what they are presenting as something helpful to me when in reality they are making an offering, hoping that I will reciprocate with some tutoring. They become frustrated and angry when I tell them that I don't want to hear about anyone else's trading techniques. I tell them that I have not even mastered my own and probably never will, but I am confident that I will make far more money for perfecting what I already know and trying to incorporate non-price action approaches into my trading. I asked them if James Galway offered a beautiful flute to Yo-Yo Ma and insisted that Ma started learning to play the flute because Galway makes so much money by playing his flute. Should Ma accept the offer? Clearly not. Ma should not continue to play the cello, and by doing so, Ma should continue to play the cello, and by doing so, he will make far more money than if he also started playing the flute. I am no Galway or Ma, but the concept is same. Price action is the only instrument that I want to play, and I strongly believe that I will make far more money by mastering it than by incorporating ideas from other successful traders. The charts, not the experts on television, will tell you exactly how the institutions are interpreting the news. Yesterday, Costco's earnings were up 32% on the quarter and above analysis expectations. See Figure 1.2. Cost gapped up on the open, tested the gap on the first bar, and then ran up over $1 in 20 minutes. It then drifted down to test yesterday's close. It had two rallies that broke bear trend lines, and both failed. This created a double tap bar 2 and 3, bear flag or triple bottom bar 1, 2 and 3, and the market then plunged $3 below the prior day low. If you were unaware of the report, you would have sorted at the failed bear trend lines break at bar 2 and 3, and you won't have sold more below that bar 4, which was a pullback that followed the breakout below yesterday's low. You would have reversed to long on the bar 5 big reversal bar, which was the second attempt to reverse the breakout below yesterday's low and a climatic reversal of the breakout of the bottom of the steep bear trend channel line. Alternatively, you could have bought the open because of the bullish report and then worried about why the stock was collapsing, instead of soaring the way the TV analysis predicted, and you would likely have sold out your long on the second plunge down to bar 5 with $2 loss. Any trend that covers a lot of points in very few bars, meaning that there is some combination of large bars and bars that overlap each other only minimally, will eventually have a pullback. These trends have such a strong momentum that the odds favor resumption of the trend after the pullback and then a test of the trend's extreme. Usually the extreme will be exceeded as long as the pullback does not turn into a new trend in the opposite direction and extend beyond the start of the original trend. In general, the odds that a pullback will get back to the prior trend extreme fall substantially if the pullback retraces 75% or more. For a pullback in a bear trend at that point, a trader is better off thinking of the pullback as a new bull trend rather than a pullback in an old bear trend. Bar 6 was about a 70% pullback, and then the market tested the climatic bear low on the open of the next day. Just because the market gaps up on a news item does not mean that it will continue up, despite how bullish the news is. As shown in figure 1.3, before the open of bar 1 on both Yahoo charts, daily on the left, weekly on the right, the news reported that Microsoft was looking to take over Yahoo. At $31 a share, and the market gapped up almost to that price. Many traders assumed that it had to be done deal because Microsoft is one of the best companies in the world, and if it wanted to buy Yahoo, it certainly could make it happen. Not only that, Microsoft has so much cash that it would likely to willing to sweeten the deal if needed. Well, the CEO of Yahoo said that his company was worth more like $40 a share, but Microsoft never countered. The deal slowly evaporated along with Yahoo's price. In October, Yahoo was 20% below the price where it was before the deal was announced and 50% lower than on the day of the announcement, and it continues to fall. So much for strong fundamentals and a takeover offer from a serious suitor. To a price action trader, a huge up move in a bear market is probably just a bear flag, unless the move is followed by a series of higher lows and higher highs. It could be followed by a bull flag and then more of a rally, but until the bull trend is confirmed, you must be aware that the larger weekly trend is more important. The only thing that is as it seems in the chart, if you cannot figure out what it is telling you, do not trade. Wait for clarity, it will always come, but once it is there, you must place the trade and assume the risk and follow your plan. Do not deal down to a 1 minute chart and tighten your stop because you will lose. The problem with 1 minute chart is that it tempts you by offering lots of entries with smaller bars and therefore a smaller risk. However, you will not be able to take them all, and you will instead cherry pick, which will lead to the death of your account because you will invariably pick too many bad cherries. When you enter on a 5 minute chart, your trade is based on your analysis of the 5 minute chart without any idea of what the 1 minute chart looks like. You must therefore rely on your 5 minute stop and targets, and just accept the reality that 1 minute chart will move against you and hit a 1 minute stop frequently. If you watch the 1 minute chart, you will not be devoting your full attention to the 5 minute chart, and a good trader will take your money from your account and put it into his account. If you want to compete, you must minimize all distractions and all inputs other than what is on the chart in front of you. And trust that if you do, you will make a lot of money. It will seem unreal, but it is very real. Never question it. Just keep things simple and follow your simple rule. It is extremely difficult to constantly do something simple, but in my opinion, it is the best way to trade. Ultimately, as a trader understand price action better and better, trading becomes much less stressful and actually pretty boring but much more profitable. Although I never gamble because the combination of odd risk and reward are against me and I never wanted to be against math. There are some similarities with gambling, especially in the minds of those who don't trade. Gambling is a game of chance, but I prefer to restrict the definition to situations where the odds are slightly against you and you will lose over time. Why these restrictions? Because without it, every investment is a gamble, since there is always an element of luck and a risk of total loss. Even if you buy investment real estate, buy a home, start a business, buy a blue chip stock, or even buy treasury bonds, the government might choose to devalue the dollar to reduce the real size of our debt. And in so doing, the purchasing power of the dollar that you will get back from those bonds would be much less than when you originally bought the bonds. Some traders use simple game theory and increase the size of trade after one or more losing trades. This is called a martingale approach to trading. Blackjack card counters are very similar to trading range traders. The card counters are trying to determine when the math has gone too far in one direction. In particular, they want to know when the remaining cards in the deck are likely overweighted with face cards. When the count indicates that this is likely, they place a trade bet based on the probability that a disproportionate number of face cards will coming up, increasing the odds of winning. Trading range traders are looking for times when they think the market has gone too far in one direction and then they place trade in opposite direction. Fate. I tried playing poker online a few minutes without using real money to find similarities to and differences from trading. I discovered early on that there was a breaker for me. I was constantly anxious because of the inherent unfairness due to luck, and I never want luck to be a large component of the odds for my success. This is a huge difference and makes me see gambling and trading as fundamentally different. Despite public perceptions, in trading, everyone is dealt the same cards, so the game is always fair, and over time, you get rewarded or penalized entirely due to your skill as a trader. Obviously, sometimes you can trade correctly and lose, and this can happen several times in a row due to the probability curve of all possible outcomes. There is a real but microscopic chance that you can trade well and lose 10 or even 100 times or more in a row, but I cannot remember the last time I saw as many as 4 good signals fail in a row. So this is a chance that I am willing to take. If you trade well over time, you should make money because it is a zero sum game except for commission, which should be small if you choose an appropriate broker. If you are better than most of the other traders, you will win their money. There are two types of gambling that are different from pure game of chance, and both are similar to trading. In both sports betting and poker, gamblers are trying to take money from other gamblers rather than from the house, and therefore they create odds in their favor if they are significantly better than their competitors. However, the commission that they pay can be far greater than those that a trader pays, especially with sports betting, where the wig is usually 10%, and that is why incredibly successful sports gamblers like Billy Walters are so rare. They have to be at least 10% better than the competition just to break even. Successful poker players are more common, as can be seen on all of the poker shows on TV. However, even the best poker players do not make anything comparable to what the best traders make because the practical limits to their trading size are much smaller. I personally find trading not to be stressful because the luck factor is so tiny that is not worth considering. However, there is one thing that trading and playing poker share, and that is the value of patience. In poker, you stand to make far more money if you patiently wait to be bet on only the very best hands, and traders make more money when they have the patience to wait for best setups. For me, this protracted downtime is much easier in trading because I can see all of other cards during the slow times, and it is intellectually stimulating to look for subtle price action phenomena. There is an important edge in gambling that is true in all areas, and that is that you should not pay until you have a good hand. In trading, that is true as well. Bet for a good setup before placing a trade. If you trade without discipline and without a sound method, then you are relying on luck and hope for your profits, and your trading is unquestionably a form of gambling. An unfortunate comparison is from non-trader who assume that all the trader and all market traders for that matter are addicted gamblers and therefore have a mental illness. I suspect that many are addicted in the sense that they are doing it more for excitement than for profit. They are willing to make low probability bets and lose large sums of money because of the huge rush they feel when they occasionally win. However, most successful traders are essentially investors. Just like an investor who buys commercial real estate or a small business, the only real difference from any other type of investing are that the time frame is shorter and the leverage is greater. Unfortunately, it is common for beginners to occasionally gamble, and it invariably costs the money. Every successful trader trades on the basis of rules. Whenever Whenever traders deviate from these rules for any reason, they are trading on hope rather than logic and are then gambling. Beginning traders often find themselves gambling right after having a couple of losses. They are eager to be made whole again and are willing to take some chances to make that happen. They will take trades that they normally would not take because they are eager to get back the money they just lost. Since they are now taking a trade that they believe is a low probability trade and they are taking it because of anxiety and sadness over their losses, they are now gambling and not trading. After they lose on their gamble, they feel even worse. Not only are they even further down on the day, but they feel especially sad because they are faced with the reality that they did not have the discipline to stick to their system when they know that discipline is one of the critical ingredients to success. Interestingly, Neurofinance researchers have found that brain scan images of traders about to make a trade and anti indistinguishable from those of drug addicts about to take a hit. They found a snowball effect and an increased desire to continue regardless of the outcome of their behavior. Unfortunately, when faced with losses, traders assume more risk rather than less, often leading to death of their accounts. Without knowing the neuroscience, Warren Buffett clearly understood the problem as seen in his statement. Once you have ordinary intelligence, what you need is the temperament to control the urges that get other people into trouble in investing. The great traders control their emotions and constantly follow their rules. One final point about gambling. There is a natural tendency to assume that nothing can last forever and that every behavior regresses toward a mean. If the market has 3 or 4 losing trades, surely the odds favor the next one being a winner. It's just like flipping a coin. Is not it? Unfortunately, that is not how market behave. When a market is trending, most attempts to reverse fail. When it is in trending wins, most attempts to break out fail. This is the opposite of a coin flip, where the odds are always 50-50. In trading, the odds are more like 70% or better. What just happened will continue to happen again and again. Because of the coin flip logic, most traders at some point begin to consider game theory. Martingale techniques work well in theory but not in practice because of the conflict between math and emotion. This is the Martingale paradox. If you double or even triple your position size and reversal at each loss, you will theoretically make money. Although 4 losers in a row is uncommon on the fifth 5-minute mini chart, if you choose your trades carefully, they will happen, and so will a dozen or more, even though I can't remember ever seeing that. In any case, if you are comfortable trading 10 contracts, but start with just one and plan to double up and reverse with each loss, 4 consecutive losers would require 60 contracts on your next trade, and 8 consecutive losers would require 256 contracts. It is unlikely that you would place a trade that is larger than your comfort zone following 4 or more losers. Anyone willing to trade one contract initially would never be willing to trade 16 or 256 contracts, and anyone willing to trade 256 contracts would never be willing to initiate the strategy with just one. This is inherent, insurmountable mathematical problem with this approach. Since trading is fun and competitive, it is natural for people to compare it to games, and because wagering is involved, gambling is usually the first thing that comes to mind. However, a far more apt analogy is to chess. In chess, you can see exactly what your opponent is doing, unlike in card games where you don't know your opponent's card. Also, in poker, the cards that you are dealt are your purely by chance, but in chess, the location of your pieces is entirely due to your decision. In chess, nothing is hidden, and it's simply your skill compared to that of your opponent that determine the outcome. Your ability to read what is in front of you and determine what will likely follow is a great asset both to a chess player and a trader. Lay people are also concerned about the possibility of crashes, and because of that risk, they again associate trading with gambling. Crashes are very rare events on daily charts. These non-traders are afraid of their inability to function effectively during extremely emotional events. Although the term crash is generally reserved for daily charts and applied to bear market of about 20% or more happening in a short time frame. Like in 1927 and 1987, it is more useful to think of it as just another chart pattern because that removes the emotion and helps traders follow their rules. If you remove the time and price axis from a chart and focus simply on the price action, there are market movements that occur frequently on intraday charts that are indistinguishable from the pattern in a classic crash. If you can get past the emotion, you can make money off crashes because with all charts they display tradable price action. Figure 1.4 from Trade Station. So how market can crash in any time frame. The one on the left is a daily chart of GE during the 1987 crash. The middle is a 5-minute chart of cost after a very strong earning reports, and the one on the right is a 1-minute mini chart. Although the term crash is used most exclusively to refer a 20% or more sell-off over a short time on daily chart and was widely used only twice in past 100 years, A price action trader looks for shapes, and the same crash pattern is common on intraday charts. Since crashes are so common intraday, there is no need to apply the terms, because from a trading perspective, they are just a weird swing with tradable price action. Incidentally, the concept that the same pattern appear on all time frame means that the principle of fractional mathematical might be useful in designing trading system. In other words, every pattern subdivides into standard price action pattern in similar time frame chart, and trading decision based on price action analysis therefore work in all time frames. How to read these books? I tried to group the material in three books in sequence that should be helpful to traders. Book 1: Trading Price Action Trends, Technical Analysis of Price Charts Bar by Bar for the Serious Traders. The basic of the price action and candles. The market is either trending or in a trading range. That is true of every time frame down to even an individual bar, which can be trend bar or non-trend bar, doji, trend lines and trend channel lines. These are basic tools that can be used to highlight the existence of trend and trading ranges. Trends. These are the most conspicuous and profitable components of every chart. Book 2: Trading Price Action Trading Ranges, Technical Analysis of Price Chart Bar by Bar for the Serious Trader. Breakouts. These are transactions from trading ranges into trends. Gaps. Breakouts often create several types of intraday gaps that can be helpful to traders, but these gaps are evident only if you use a broad definition. Magnets, support and resistance. Once the market breaks out and begins its move, it is often drawn to certain prices, and these magnets often set up reversals. Pullback. These are transitions from trend to temporary trading ranges. Trading ranges. These are areas of largely sideways price activity, but each leg is a small trend. An entire trading range is usually a pullback in trend on a higher time frame chart. Order and trade management. Traders need as many tools as possible and need to understand scalping, swinging trading, and scaling into and out of trades, as well as how to enter and exit on stops and limit orders. The mathematical of trading. There is a mathematical basis for all trading, and when you see why things are unfolding the way they do, trading becomes much less stressful. Book 3: Trading Price Action Reversal, Trend Reversal. These offer the best risk reward ratio of any type of trade, but since most fail, traders need to be selective. Day trading. Now that readers understand price action, they can use it to trade. The chapters on day trading, trading the first hour, and detailed examples show how. Daily, weekly, and monthly charts. These charts have really very reliable price action setups. Options. Price actions can be used effectively in option trading. Best trades. Some price action setups are especially good, and beginners should focus on these guidelines. These are many important concepts that can help keep readers focused. If you come across an unfamiliar term, you should be able to find its definition in the list of terms at the beginning of the book. Some books show charts that use the time zone of the location of the market, but now that trading is electronic and global, that is no longer relevant. Since I trade in California, the charts are in Pacific Standard Time. All of the charts were created with trade stations. Since every chart has dozens of noteworthy price action events that have not yet been covered, I described many of them immediately after. the primary discussion under deeper discussion of this chart. Even though you might find the incomprehensible when you first read it, you will understand it on a second reading of the books. The more variation of a standard pattern that you see, the better you will be able to spot them as they are developing in real time. I also usually point out the major one or two traits on the chart. If you prefer, you can ignore that supplemental discussion on your first read and then look at the charts again after completing the books when the deeper discussion would be understandable. Since many of the setups are excellent examples of important concepts, even thought not yet covered, many readers will appreciate having the discussion if they go through the books again. At the time of publication, I am posting a daily end of day analysis of the E-mini and providing real-time chart reading during the trading day at www.brookspriceaction.com. All of the charts in the three books will be in larger format on John Wiley and Sons site at www.wiley.com. Go/trading trends. See the About the website page at the back of the book. You will be able to zoom in to see the details, download the charts or print them. Having a printout of chart when the description is several pages long will make it easier to follow the commentary. Signs of strength: trends, breakouts, reversal bars, and reversals. Here are some characteristics that are commonly found in strong trends. There is a big gap opening on the day. There are trending nights and lows, highs and lows. Most of the bars are trend bars in the direction of the trend. There is very little overlap of the bodies of consecutive bars. For example, in a bull spike, many bars have lows that are at or just one tick below the closes of the prior bar. Some bars have lows that are at not below the close of the prior bar, so traders trying to buy on a limit order at the close of the prior bar do not get their orders filed and they have to buy higher. There are bars with no tails or small tails in either direction indicating urgency. For example, in a bull trend, if a bull trend bar opens on its low tick and trends up, traders were eager to buy it as soon as the prior bar closed. If it closed on or near its high tick, traders continued their strong buying in anticipating of new buyers entering right after the bar closes. They are willing to buy going into the close because they were afraid that if they waited for the bar to close, they might have to buy a ticker or two higher. Occasionally, there are gaps between the bodies. For example, the open of a bar might be above the close of the prior bar in bull trend. A breakout gaps appear in the form of a strong trend bar at the start of the trend. Measuring gaps occurs where the breakout test does not overlap the breakout points. For example, the pullback from a full breakout does not drop below the high of the bar where the breakout occurred. Micro measuring gaps appear where there is a strong trend bar and a gap between the bar before it and the bar after it. For example, if the low of the bar after strong bull trend bar in bull trend is at or above the higher of the bar before the trend bar, this is a gap and a breakout test and a sign of strength. No big climax appears. Not many large bars appear, not even large trend bars often. The largest trend bars are counter-trend, trapping traders into looking for counter-trend traders and messing with trend trades. The counter-trend setups always look better than the with trend setups. No significant trend channel line overshoots occur, and the minor ones result in only sideways corrections. There are sideways corrections after the trend line breaks. Failed wedges and other failed reversal occurs. There is a sequence of 20 moving average gaps or 29 consecutives.